All right. So where we had left off in our forecasted valuation of Google is we had created an 11-year forecast. And from here, I'm going to save the file just so we have a new version, and I'm going to call it the Google model for in-class valuation. So we're going to finish up the valuation from that file. So in terms of where the model is today, we've set up so that the ratios are forecasted going forward, and that the forecasted ratios create the forecasted financial statements, income statements, balance sheets, and ultimately the cash flows that we're about to forecast. And that created the economic statements of TFI, TII, and CFI. So what we want to then do is we want to come to the row of tabs and we want to add a new tab, and we're going to add a tab called DCF Valuation. So this is going to be our Enterprise Discounted Cash Flow Valuation tab, right? So we're going to add that to our model, and then we're also going to add an Economic Profit or EP Valuation tab in just a minute as well. So let me change my zoom, make it a little bit easier to see as we get started. Now, this is going to end up looking a lot like from the McKinsey book. They had done a DCF valuation of Home Depot, and we're going to follow a very similar process when we do the enterprise DCF valuation. So in order to have it all print out on one sheet of paper, an 8.5 by 11 sheet of paper, we're going to actually have, we're going to switch the rows and the columns. So going down the rows will be the years as opposed to going across the columns. So when we do an enterprise DCF valuation, what we're forecasting, we'll start out with the operating value, is we're forecasting the free cash flows because that gives us the operating value. So what we're going to care about is the free cash flow. And our first forecast year, we want to make this a relative reference for free cash flows on the CFI tab. In Google's case, it was 2013, so cell H1. Right? And again, relative references equals previous year plus 1. I want to go all the way down to 2022. Now you'll notice that in our model we'd actually forecasted through 2023, except I'm only going to go through 2022 because as the book talked about, you always do one extra year of cash flow forecast because that year plus 1 or N plus 1 year is the beginning of your continuing value period. Right? So what we've done in the model is we're arbitrarily choosing a 10-year period of defined forecast, and then year 11 is the continuing value period. So year 11 into perpetuity. All right, so we have two periods in our model. The model where we forecast year by year by year, and then when we're too difficult to forecast anymore, we go to continuing value. Now arbitrarily, we've chosen 10 years for this model of defined, and the year 11 is the continuing value period. And I state that that's arbitrary. In an ideal world, what you want is you want the company to be mature when you forecast continuing value rather than to be in growth stage. So typically you want to model the entire growth stage of the company. So Google, we actually might need to model more than 10 years before we consider them to be mature. But for purposes of just building the arbitrary model, we're just going to go out 10 years. Okay? Matter of fact, for some companies, you might only need to go out 3 years of forecasting. And then starting in year 4, you could do continuing value because they're already pretty mature. So in this case, we're still going to do arbitrarily 10 years. Right? So back to our enterprise DCF model, over here in the DCF valuation, we're going to forecast the free cash flows for 10 years. And then I'm just going to basically pull them from the CFI tab. So our model had created a forecast for free cash flow equals from the CFI tab. 2013 free cash flow, including goodwill, because we do valuation, it always includes goodwill. So 2013 would be H12. 2014 from the CFI tab would be I12. 2015 would be J12. 2016 K12. 2017 would be L12. 2018 would be M12, 2019 N, 2020 out the CFI tab O, 2021 P, and 2022 Q. So those are our forecasts for free cash flows for the next 10 years. HIJKLMNOPQ. Okay. Assuming that our model comes true. Now what we next need to do is we need to present value this. So we need to discount these cash flows. So I'm just going to put in a field called discount factors. So I'm kind of old school. Because we used to, back in my day when I was in business school, we would take the cash flow, multiply it by the discount factor, and that would get us the discounted free cash flow. You could use the Excel present value template if you wanted to. But basically, the discount factor is 1 divided by 1 plus the discount rate to the power of t or power of n for a number of periods. And so in this case, we'll take 1 divided by 1 plus, and that's going to be off of our assumptions tab. We have an estimate for a cost of capital. So we're going to use the weighted average cost of capital as our discount rate. And again, because we're assuming that companies manage to a target capital structure, then the WACC stays constant over the DCF valuation horizon. All right, so essentially, we'll use 1 WACC, which means I'm going to make this an absolute reference to cell B4, put a $sign in front of a B, a $sign in front of the 4. And then I'm going to copy this down. Except in 2014, I got to take 1 plus R squared, so to the power of 2. 2015, so 3 years out, I need to take it out to the power of 3, power of 4, power of 5, 6 power, 7th, 8th, to the 9th power, and the 10th year to the 10th power. So 1 plus R squared, 1 plus R cubed, to the 4th, 5th, 6th, 7th, 8th, 9th, and 10th. That means if I take my free cash flow and I multiply it by that discount factor, this would be the discounted free cash flow in present value. And just it's a little bit easier to see, I'll make it 2 decimal places. Okay. So all we've done is just present value these cash flows. So if the cash flows come true that we have forecasted, these will be the free cash flows that Google, in this case, will earn over the next decade. Right? And in present value, adjusted for risk, if we sum those up, this will be the operating value for next 10 years will be the sum of these discounted free cash flows. So again, if those financial statements come true based on the ratios that we're forecasting over the next decade, we're saying Google's worth approximately $213 billion of operating value based on the free cash flows it will generate over the next 10 years. Right? That's essentially what we're saying for the DCF. Right? Except Google's not going out of business in a decade. Again, we make an assumption that companies last forever when we value them. Right? And so we've only forecasted the defined period. Now we have to forecast year 11 until forever, which is what we're calling the continuing value or CV period of the company. So what we're then going to do is we're going to say, okay, now let's forecast the continuing value of Google. Right? Well, to forecast continuing value, we use the growing perpetuity, and that's where McKinsey had rearranged the growing perpetuity to create the key value driver formula. Because remember, this formula allows us to forecast what they call a RONIC, a return on new incremental capital, or basically a forecasted ROIC, as opposed to a historical ROIC. So remember, the growing perpetuity said that the internal rate of return on future cash flows is the same as the past. And we may want to vary the future, so therefore we're going to use the key value driver formula, which allows us to forecast an ROIC, also known as a RONIC, right? So essentially, this is what we're going to put into our model. So it says take the NOPLAT in T plus 1. That's actually the first year of the continuing value period. That's actually why we forecasted that 11th year. So that T plus 1 is the 11th year, right? And then we need a long-term growth rate. We need a long-term ROIC, representative ROIC for the firm, called RONIC, return on new incremental capital. And we need the WACC. So what I'm going to do, just so it's all in one place, and I might want to change this in the future, is I'm going to go back to my assumption screen, and I'm going to start adding those values. So in the assumption screen, I'm going to have my CV NOPLAT, my CV RONIC, also known as ROIC, and I'm going to have my long-term G, my long-term growth rate. And again, I'll make those yellow because those are items that I could theoretically change. Right? Now, I already have a WACC. Next, what I need is a continuing value NOPLAT. Well, we've already forecasted the first year of the continuing value, so that's the 2023 NOPLAT in our model. So in this case, I'm going to make a cell reference on the Assumptions tab to go to the TII, which is where my forecast of NOPLAT is, and I go to my 2023 forecasted NOPLAT. For my continuing value ROIC, we have a forecast for that in the economic profit tab. In the economic profit tab, we solve for an ROIC. And very important, we want to use the beginning of year economic profit ROIC. And the reason why we're going to use the beginning of year is because mathematically that's the way that the DCF and the EP valuations match. All right, that's why we're going to use BOY ROIC. So mathematically we will know they're matching. If we use end of year ROIC, we'll come close. If we use beginning of year, we will be exact. So we're going to use beginning of year to get the two valuations to sync up. So in this case, I'll go to my economic profit BOY tab. I will look at my economic profit after goodwill and that return on invested capital, which is row 15. It'll be Q as in Queen 15. That's their continuing value ROIC. Right? And then finally, that should be, ultimately, that's a percentage. And I will format cells. I'll make that to one decimal place. And then we need a G. And our default G, we're going to start out with is 3%. Right? Now, G is the growth rate in cash flow forever. So it's really the growth rate, think of it as for the next 20 years. How fast is cash flow going to grow for a mature firm over a 20-year period of time? Generally, for US and European companies, that's going to be probably around the GDP rate for most companies. Therefore, approximately 3%. So since most countries these days, developed US and European countries, are growing in the 2 to 3% range, we're going to start out with just a general assumption of about 3%. Now, obviously, we can vary that, but that's really the point, is that it's not going to be, and if you think about the formula, can't be above the cost of capital. So G is always bounded by the cost of capital. You can't grow faster than the cost of capital. Otherwise, if you did, you'd eventually own the world. So if you had a positive spread and you grew faster than your cost of capital, nobody would buy anything else. You'd eventually own the world. So that's not going to happen. And then the other side of it is usually most companies don't have negative growth rates into infinity. So usually between 0 and your cost of capital is where you're bound. And as I said, we're going to start out with an assumption of 3%, which we can always adjust later. But that would be the idea that the company's mature. If we forecasted 10 years and the company's not mature, we're probably going to use a number higher than 3%. And if it's mature, probably hopefully closer to 3, maybe even 2 or 1, depending on where the company is in its life cycle. Right? So those are our four items we need for continuing value. So going back to our DCF valuation tab, what I'm now going to do is I'm going to take my continuing value and using those assumptions, put in this formula with the correct order of operations. So I take my equals, I'm going to do this all off the assumptions page, my continuing value no plat, this will be easier to make sure I get this right, equals left paren, start with that, off my assumptions page, continuing value no plat times left paren, 1 minus the growth rate, the G, divided by the ROIC, right paren, divided by left paren, the WACC, minus the G, right paren. A really big number. 3 billion. Okay. How about that? That's basically the formula that you need to get in with the correct order of operations. Right? So again, what we're saying is assuming that those continuing value numbers, which obviously are ridiculous, and we will go back and adjust them later, but assuming those ridiculous values actually were to come true, this is what that continuing value period would be worth. If they generated, 200, whatever it was, 100 billion of, or I think it was like 200 billion of no pad or no plat, and it kept growing with an ROIC of 92% into infinity, they'd be worth a ridiculous amount. Yes? Well, for practical purposes, we're not really forecasting acquisitions because we're assuming most acquisitions are NPV 0. So it's really primarily organic growth. So it's growth, but we're assuming that the organic growth is the one that's going to matter. There's lines to forecast goodwill. And like I said, if we want to adjust our model to try and forecast acquisitions, we can. But I'm just telling you, the average acquisition, according to most academic studies, including the most recent one I remember reading about a month or so ago, says the average acquisition still destroys value. You could. Yeah, if you're an industry that's in decline, you absolutely could have negative growth. Matter of fact, if we valued Microsoft today, their stock price assumes and implies negative growth. Best is behind them. That's what the market thinks today. And after the fact that they have 3% market share worldwide of the phone market, and both Nokia and BlackBerry are basically in horrible shape, it doesn't bode well for Microsoft as even the number 3 vendor. That Android and iOS are taking over the mobile world, and Microsoft just has no presence there whatsoever. Yeah. Because they still have a monopoly of the computers, which is generating a huge amount of profit for a while. But that's the key point. It's for a while. So they'll just slowly decay until Steve Ballmer's replaced and somebody else comes in there who has a vision. Right? So, but again, we'll come back and talk about that later. Maybe we'll make Microsoft one of our examples. But here's the point. This value is the continuing value period, which implies a discount rate and has valued it to the beginning of 2023, which is actually the end of 2022. So we're going to assume that January 1st, 2023 is basically the same as December 31st, 2022, which means I got to present value this to today. So I don't want to double discount because the year 2023 has already been discounted in the growing perpetuity formula. So to bring it back to a present value, I use the same discount factor as 2022, and then I multiply that out, and that brings it back to a present value of the continuing value. So this present values it to the beginning of 2023. This present values it back to today. I then create a concept known as the operating value of the firm. It's the sum of these two. It's the first 10 years plus the continuing value period into perpetuity. So that's the operating value of Google, our box 1 value. So that's the value of the operating cash flows. Questions about any of that? It's pretty straightforward. All right. So what we're then going to do is we're going to add in our non-operating values. All right, so 1 plus 2 equals enterprise value. So now we're going to add in the non-operating cash values to equal our enterprise value. And this is where our economic statements are going to help us. Because on the statement, and I'll start with row 17, of TFI, we have already labeled the 3 non-operating items that we have to value. So it's the excess cash, the other non-operating the excess cash, the other non-operating assets, the non-operating liabilities, and the long-term investments. Right? Those are really the other 2 things that we're going to have to value here. Right? So here's a nice thing, which is in our model, we actually have a value for the excess cash, which is the excess cash today. That's already a present value. So if I go to my TFI, the last year for Google was 2012, so I get the 2012 excess cash. And then I take my 2012 non-operating assets and my 2012 long-term investments, and those are my 3 non-operating values. They're already in present value. They're the December 31st, 2012 reported numbers. That's the non-operating value of the company. If I add those together with the operating value, I get what's called the enterprise value. So I sum the operating value and those 3 non-operating assets, net of the non-operating liabilities. And that gets me the enterprise value forecast for the company, or EV. Right? Now, cash, like I said, we're using the value of the cash on hand. It's already in the present value. Cash is cash. Non-operating assets, it's hard to know what they are, so we generally assume that the book value is representative. The one question is long-term investments. Google has probably made lots of investments that they don't control, but just have minority investments in a lot of different tech firms. And the market value of some of those could actually be pretty high. But remember that if, as a company, the accountants don't let us mark up the value of our investments. They only let us put the book value of those investments. So what we're going to do is I'm going to go to my assumptions tab, and I'm going to put in a price to book multiplier. So I'm going to call it the PB multiple of long-term investments. I'm going to make it a yellow cell, and I'm going to start it out with a value of 1. And what this does is that PB is price to book multiple. It allows me to put in a multiplier for the value of the long-term investments if they're worth more than what the company has them recorded on the books. All right? So I know that generally what they have on their accounting statements is a floor, because if the value goes down, the accountants let you write it off. But if the value goes up, they don't let you write it up. So I want the multiplier in there, because if I don't know anything about their investments, I'll say, well, at least they're probably representative of what's on their balance sheet, but they could be worth a lot more. So for example, Microsoft bought 1/15 of Facebook 5 years ago. Right? There's a lot of value to Facebook, even with their declined stock price from their IPO, versus what Microsoft originally put in, because Microsoft bought in when Facebook was valued at about $15 billion. Right? And so Facebook is worth a lot more than that today. So the value of Microsoft's investment in Facebook, we would put a multiplier on that. Right? So they're going to be worth a lot more than that. So let's say Facebook, I don't know the exact number today, but it's probably worth around, what, 60, 70 billion? Then I might put a 4 times multiplier on that if they'd put in at 15 and it's worth 60. Right? So that's the point, is that this allows me to multiply it. So what I'm going to do is go to my DCF valuation. I'm going to take my long-term investments, and I'm just going to multiply that by my ratio, or my assumptions, my price to book multiple. Again, if I leave it at 1, it just means I'm using book value. But again, process-wise, I've basically forecasted the value of the operations. I've added in the non-operating value. I've added them together, and that's really what enterprise value is. That's my forecast for enterprise value.
You just multiplied the enterprise value by
Not the enterprise value, just the long-term investment value.
okay.
Yeah, because I don't want to adjust that enterprise value directly. That's the result of everything above. But as I'm saying, the long-term investments would include those equity investments where you don't control the company, and the accounts would put that into that category. So that's what I'm saying. They put them in at book value, but they could be worth more than book value. So that's why I'm putting in that multiplier. But I'm leaving the multiplier at 1, which basically says equals book value unless I know otherwise.
So, I think in that you have multiplied also the long-term receivables.
That's correct.
So the long-term receivables, you consider them as.
Right now, I'm putting them in there, and I would have to break those two out eventually if I thought the company had a lot of long-term receivables.
Okay.
But since I'm basically leaving the multiplier at 1, it doesn't directly affect it right now, and would only affect it if I knew the value. But again, that's the point. If I'm doing my research on the company, I should have some sense of what their value is. So, for example, we talked about Molson Coors earlier. They have a joint venture with Miller, and I need to know what the value of that joint venture is outside of Molson Coors. And if I don't, then I don't really have a clear understanding of their valuation. Because if I actually did the cash flow value of Molson Coors, I'd come up with about half the share price of Molson Coors, right? And so that's the point. I'd need to know that, hey, there's this joint venture over here that people are putting a lot of value on. And if I didn't know that, then I really wouldn't understand what was happening with the company, right? For Google, it's probably not going to make as much of a difference, but for some other companies, it could.
So if a company like has a lot of receivables, then you would probably be best to break it out.
It probably, yeah. Yes.
This doesn't really pertain to what we're doing now, but
It's okay.
CFI tab.
Yep.
So we get to free cash flow.
Yep.
And by the time we get to cash flow available to investors, it actually stays really low and fixed throughout because we're sort of letting the company in this valuation just pile up huge amounts.
Because all that cash is going into excess cash. That's exactly right.
And what was our rationale behind that again?
Well, as I said, one, we needed a plug to balance the balance sheet. So basically the question for anybody that's listening on the video is just why are we using excess cash as a plug? Why are we letting it pile up? Because one, we need a plug. And then two, instead of individually forecasting year by year dividends and interest and capital structure, we're just kind of leaving it constant. And therefore, all of the excess cash becomes a proxy for what the CFI could be. So,
Just like easy to find again.
yeah. So, for example, yesterday I was in London with Ericsson, and I was talking to some of their senior people, and basically, Ericsson has a huge amount of cash on their balance sheet. In fact, half their share price is probably cash, right? Because they just have a lot of cash, just nature of technology companies, and telcos are as well. And that's the point. They look at it as, basically dry powder that if they ever needed to do an acquisition, it's there. That they have just flexibility in the technology world to go do some things. So for there, if it's really excess cash that right now it's just sitting in marketable securities around the world, they could also decide to give it out as a dividend. And so there's nothing preventing them from paying it out. And if they did, then basically they could immediately distribute it. But from a risk standpoint, it's just all sitting in risk-free securities around the world. So I'm not going to charge you a cost of capital for it. That's why we're putting it into the non-operating category. And it's just sort of discretionary cash. But I want to forecast what happens to that discretionary cash over time because that is my forecasted payout. Yeah.
So a follow up on that, why not just not bring cash CFI in future years just all the way down to zero? It's really like stuck around there, 65.
You mean why not have that go to zero?
Yeah.
Well, because then where would we put it?
Sorry, like on the CFI tab,
Yeah.
each.
Well, what we're doing is it's in Google's case, it's practically close to zero because it really just goes back to the fact that they have some interest that's being paid out and we haven't paid out the debt. So we're just going to assume that whatever interest that they're paying now, they're going to keep paying in the future. And in a way, it's almost like an arbitrary number because realistically, if they really have this much cash, there's no reason to pay that debt. They'll pay it off. Okay. All right. Yes.
On the DCF valuation.
Yep.
So on the first part, where you're getting the operation value for the first 10 years plus the continuing value, you're adding that, and then to it you're adding excess cash for only 1 year.
The current years.
Right.
Because the operating value we're forecasting, the non-operating value we're using the existing values. So you got to think about why we're doing this. And that's I think what you're implying.
Right.
Is what we're inferring is that all non-operating assets going forward are the equivalent of NPV 0. So if you invest your cash risk-free, it's basically NPV 0 today. If you have non-operating assets that don't earn anything, then basically the book value is the value of those non-operating assets. If you have long-term investments that have a certain value, then we're going to say that they're basically just going to grow at the cost of capital over time. And they're not going to really incrementally improve their value versus what you already have today on the books, that they'll just grow at whatever the cost of capital is over time. Now, if you believe that for whatever reason a company will be different than that, then you could make explicit forecasts of the non-operating values. But traditionally, people don't. Traditionally, people just take the non-operating values as a present value today. And so therefore, it's the numbers on their most recent statement. Because it's hard enough to forecast the operating values, it's even more difficult to forecast the non-operating values. Because that's the point, they're non-operating. It's not like I have a good basis for forecasting what those values are. So I usually just appraise them today and say that's the value. And that's what I'm adding to the operating value to get my enterprise value. Right? And for most companies, you can see Google, the operating value typically dwarfs the non-operating values. And so they become key to the value of the business. Right? But we add the two together, that's our enterprise value. And then from there, we now have to, remember, 1 plus 2 equals 3 plus 4. Now we have to do the debt and the equities. So now what we're going to do is we're going to subtract out all the debt and the debt equivalents. Right? So again, we can go back to our TFI. In our statement of TFI, we have listed all of the 3s and 4s. Retirement-related liabilities, interest-bearing debt. Those have to be paid off before shareholders can get paid. Next, my equity and equity equivalents. I'm solving for common equity, so I don't actually pay off the common equity because that's what's left. All right, so that would be double counting. But I would have to pay off the preferred and the minority shareholders. And then what's left is my common equity value. So again, retirement-related liabilities are present valued, so therefore 2012. For Google, it was 0, so G14. And interest-bearing debt is whatever the value of the debt is. Preferred stock is whatever the preferred stock currently is, G17, and minority interest, whatever that is. So again, I know that the regulators will not let companies today have just unlimited retirement-related liabilities. That the law basically says, as a company, you must fully fund your pensions. Right? So if they have retirement-related liabilities, I generally don't think they're going to grow dramatically because the companies won't be allowed to. The government will step in. Right? Same thing with minority interest and preferred stock. If they have preferred, I'm going to keep it constant. If they don't have it, I'm probably not going to forecast it because it's too hard to forecast joint ventures or issuance. We're leaving preferred the same. But nonetheless, whatever they have outstanding, they have to pay off. And for the interest-bearing debt, again, that is a present value. It's the value of the debt. Now, where this gets a little bit tricky is if you have a distressed company, because if the debt doesn't trade at book value and it trades at a substantial discount to book value, then we might need to come here and adjust this number. Right? And if the company has hidden debt, think back to Home Depot. If a company has a giant off-the-books lease obligation, then we might also have to deal with that as another form of debt that would have to be paid off. Okay? So that's where we'd have to see in the footnotes if a company really had called debt by proxy. So they got all these off-balance sheet leases or all these off-balance sheet derivative liabilities that they owe. We'd have to put those on there as well. So it's basically we want to subtract off every claim that is paid before the common shareholders get paid. They're the residual. They're the last in line to get paid. Right? But based on the statements we're getting from the balance sheet, these are the 4 areas that are on the TFI that are coming from Bloomberg. Right? So that leaves us a common equity value. And so the common equity value is our enterprise value minus the sum of those 4 things. Which means to forecast a share price, we need to know the shares outstanding. And that we're going to put on the assumptions tab because that will change by company. Shares, spell today, shares outstanding. And that was, as I mentioned before, off of the DES tab is the quickest way to find it in Bloomberg. So in Bloomberg, in the DES tab, or DS screen, shares out 271.1 for Google. 271.1. And again, I'll make that yellow because that's something that I could change in the future. Okay. All right, so I'm going to go back to my DCF tab. I'm going to reference that, equals, from the assumptions, 271. And that's going to give me a price per share. Forecast equals the common equity value divided by the shares outstanding. So that gives me a share price of $5,612.34. It's a little higher than what Google's trading at today. But then again, Google's not going to probably maintain their margin and grow 34% a year for the next forever. So that would probably be an unrealistic share price. And that's what we have to do. Next, we have to figure out what is a realistic share price as we adapt the model. Yes? We did. The tax impact is taken into account because here on the ratios, we forecasted a tax rate. And this tax rate, remember, make sure that for 2014 equals the previous year going forward. But we forecasted a tax rate, and therefore everything we've looked at it implies that tax rate. So it needs to be a representative tax rate that the company would pay going forward. But absolutely, we forecasted the tax impact as well. Right? So that has given us a DCF valuation. Now again, don't do this now. This is what we'll do in a few minutes. But for example, if instead of 32% a year, they grew at 5% a year, then very quickly I can come back here to my DCF valuation, see that's $800 a stock price. And by the way, right now, Google is at $880. So when we adjust to a more realistic growth and margin, then we will get a more realistic share price, right? And we haven't done that because we're just kind of building out the model here. But once we've built out the model, that's the art of what we will do next, is we'll actually put in assumptions that are more realistic and try and get a more realistic share price for the company. Yes?
When we forecast growth, it's like long-term growth is 3%, but in this, what's the current hat?
Ratios. Well, I'm just we have to forecast the next 10 years, and then year 2023 forever is really what the long-term growth rate's representing.
So this is okay from in 2023, so 32%.
Yeah, so we're 32% until 2023, and then 3% forever. But still, they're not going to grow 32% for the next decade. It's not going to happen. Right? I'll take any bet against that. This is optimistic, which is why this optimistic scenario says that they're worth $5,000 a share and they're worth $1.5 trillion of equity. Obviously, that's not what they're going to achieve. But that's the point. We're just setting up the model now. So once we've set the model up, we'll go back and we'll adjust. We got another tab that we've got to set up the model with. So what I want to do is I want to clone this tab for the discounted economic profit valuation. All right? So don't, instead of recreating the whole thing, clone it. So what that means is with your mouse, if you right click on this tab, move or copy, select create a copy, and then put it all the way at the end, just so it's next to each other, and then hit OK. And then we'll add a little number 2 by it. And then we're going to rename this tab the EP, for economic profit valuation. Right? And what we said was that if we do a different methodology, we should get the same answer as the discounted cash flow. And what's different about how we forecast the economic profit valuation is actually just how we forecast the operating value. Everything below operating value is the same. The only difference is how we forecast the operating value. So that's what we're going to do. In the EP valuation tab, we're still going to forecast out the same amount of years, but instead of forecasting free cash flow, we're going to forecast economic profit. And we're going to discount the economic profit. So instead of discounted free cash flow, we're going to have the discounted economic profits. So I need to take these and clear the contents so that what I need is my first 10 years of forecast for economic profit. Right? Well, we have that on our EPBOY tab. We forecasted the beginning of year economic profits using the beginning of year methodology, because again, we want to have these valuations match up. So for the forecasted economic profit in 2013, off the EPBOY tab, the very last line is the economic profit after goodwill, which is the one we want. So for 2013, it'll be G23. And then 2014, it'll be H23. 2015, it'll be I23. 2016, remember, use the boy tab, J23. 2017, K. 2018, L. 2019, M. 2020 is N. 2021 is O. And 2022 is P. So again, just make sure you have the right tab. It's like boy, G23, H, I, J, K, L, M, N, O, P. So what I've now done is I now have the change in value for the next 10 years. Because remember, economic profit is the one period change in value. Right? So it's not the total value created, it's just the change in the value. So we forecasted and discounted to present value the changes in value for each of the 10 years, and we've already summed them up. So we're just going to leave them summed. So we've summed the change in value the next decade. Right? What we then have to do is we have to add that to our beginning starting invested capital. Well, our beginning invested capital is off of our TFI. It's our 2012 operating invested capital in goodwill, so 23 billion. So given this forecast, we start with 23.9 billion of invested capital, and based on running our operations, we add that much to it in present value over the next decade because we're earning a positive spread. So we're adding value to what we've started with. That's the way the economic profit model works. Right? Then we have to forecast how much value we're going to add into perpetuity. So that's the continuing value. And what's different is instead of using the formula that we use for continuing value, because that was the forecast for free cash flow continuing value, we have to go back to our lecture notes. And in our lecture notes and in the book reading that we did for the last class, this is the formula, this ugly, complicated formula for continuing value of economic profit. So that's the rearranged key value driver formula using economic profit. So we had to put that formula into our model with the correct order of operations. Right? And if we do, we should get a balance between the two valuations. They should exactly balance. Not rounded to a dollar, they should balance exactly. So let's see if we can actually get this right. So what I need to do is for this continuing value, I need to basically figure out what it needs to be so that these operating values balance. Right? And then what I'll do is, just to see if they do, I'll put this little check in here. And this minus from the DCF, this operating value, that check needs to be 0. So I already know that that's the number, 1.191 billion needs to be this number, right? Now I'm smart enough to realize that you know that too once we build this model. So on your exam, I look for that. So you can't just back solve for it. You actually have to put the formula in and get it correctly. Right? That's going to be key to your final exam, because you will have to do this on your final exam. Not the midterm, but on the final.
Right. Show the formula for that check again.
Well, that's all I just did was I just took the operating value on this tab,
Yep.
and I subtracted the operating value on the other tab. Just so that the two, there can't be any difference between the two. That's how I'll know that I didn't screw up. I could just go look at the other tab and see if they're the same. That's the same thing. But I just put that little check in there, so we know that that's 0. So what do I need to do here? In the EP tab, let's start putting in this formula. So economic profit of T plus 1. So what I'm going to do is on my assumptions tab, I need to make sure, and I'm going to add in an assumption. So I'm going to insert, just because I want to put them all together. Continuing value economic profit. You can have it in a different order if you want. I just put them all together. But I need a continuing value economic profit. So what that is my T plus 1, so 2023 economic profit. So from the EPBOY tab, 2023 economic profit after goodwill, so Q23. And instead of a percentage, it's a dollar amount. All right. Just so all the variables are on the assumptions tab. All right, so now I'm going to go build this formula off the EP valuation. Hope I get it right. So equals left paren economic profit divided by WACC. So go back to the assumptions tab. Take my economic profit, divide by my WACC, right paren, plus left paren, no plat, continuing value, no plat, times left paren, G divided by ROIC, right paren, times left paren, ROIC minus WACC, right paren, take all of that, divide by left paren, WACC times left paren, WACC minus growth, right paren, right paren. Cross my fingers, say a little prayer, hope I didn't screw this up. Usually takes me a couple times to get this right sometimes, but let's see. Close. See where I screwed up. You got it right? That's good. So your check is 0?
Yep.
All right. As I said, I got to get the order of operations right. Oh, thank you. So I did get the formula right. I forgot the other part. Operating value is the sum of these 3 things. So that's what's different. Is in the DCF is just the 10-year value and the continuing value. In the economic profit world, it's the invested capital you start with, plus the change in value in the first 10 years, and then the change in value, the continuing value. So you add those 3 things together. And then, you're right, thank you, our check is 0. And I wanted to show you that it really is 0, meaning there's no errors, there's no off by $1. Right? If you're off by $1, you made a mistake, because that's the point. If you use the beginning of a year as invested capital in your calculations consistently, you will get exact. Right? Now, I'm not saying you couldn't do a valuation using end of year, right? But at least I wanted you to start out by seeing that just rearranging the equations, you get the exact same answer. And by the way, this is exactly what you're going to do in your final exam. Except instead of using a real company, I'll give you the same type of hypothetical company I'll give you on the midterm, same hypothetical company you had on the homework assignment, and you'll have to do a valuation of it. And just show that the values come up the same, even if you use multiple approaches. Okay? So again, the valuation shouldn't change as we change our methodology. Yes? Sorry, what I forgot to do is just add these three things together. So sum 12, 13, and 14. D12, D13, D14.
But in the previous one on the valuation, you didn't add it.
In the DCF, we didn't because we didn't worry about the starting invested capital in the DCF. So that's what I'm saying. In DCF, we look at the actual cash flows you generate and value them. In economic profit, we look at the change in the value based on an initial level of investment. So we added in the initial level of investment in the economic profit, and then we added the two changes in value periods. The change in value for the first decade, and then the change in value from year 11 into perpetuity, called the continuing value period. And we add those three things together, that becomes the operating value of the firm. Same non-operating assets, same everything else, same share price, independently calculated. Right? So last thing we're going to do is we're going to, two last things. First, on the ratios tab, I'm just going to put here my forecasted share price, and I'm just going to reference the DCF value price per share, so that as we make changes to the ratios, we can quickly see what that forecasted share price will be. So we don't have to keep jumping back and forth on the sheets. Yes? You can also reference the EP value per share. It's basically the same thing.
Doesn't matter if you take it from economic profit or.
That's what I'm saying. You could take it from the EP tab as well, because theoretically you have the same value. But I'm just doing it more for convenience, so that when we actually try and get to a more realistic share price for Google, then we don't have to keep jumping back and forth on the screens. So I'm just making it a relative reference. So again, I changed the ratio. I can quickly see what the share price looks like. And then the other thing that we're going to do when we forecast is we have to make sure that we're creating a realistic valuation. So in advance of doing this, we're going to create a little chart. And what we're going to do is in the EPBOY tab, we have a forecast. We have historical and forecasted ROIC, which is row 15. So what I want to do is I want to take row 15 of my EPBOY tab and insert a chart, either into a blank sheet or I can put it into a new chart sheet, either one. So create a sheet and add this to it, or you can create the chart in the existing sheet and move it over just so you can see this, or you can create a chart sheet. But basically, I want a line chart. Why it's not giving me the ability to do a line chart, I don't remember, because I hate Excel. There's something causing me not to be able to do a line chart.
That's a line chart of what?
It's a line chart. Well, this is a bar chart.
Bar chart.
I want it to be a line chart, and there's a reason why Excel's. But what it really represents is it's a line chart from the economic profit ROIC. I just want to do that. Let me try this. Insert sheet, chart sheet. All right. Right click. Right click on the chart. Change chart type. Change chart type. And then I'll figure this out after the video, but here's the point. I'm going to leave it as a bar. Ideally, it's easier to see as a line. But what it really represents, and I'm going to select my data, and what I want to do is add in an x-axis, and the x-axis is the years. So starting in 2008 and going all the way through 2023, what we've just done is we've created a chart that has the historical and forecasted ROICs. Right? And what we know is that ROIC should tend to regress to the mean over time. And what's happening in our model is in the out years, the ROIC is getting better and better and better and better every year. Well, that's probably not realistic. Right? That's why they have a $5,700 share price. And so this becomes sort of our check as to how we think about the share price. So we're going to call this the ROIC chart. Okay. So it's a forecast of historical and future ROICs. So this completes the next step of our in-class valuation of Google. All right. And then from here, what we're going to do is we're then going to do the actual valuation now that we've kind of set up the model.